Bristol-Myers Squibb is one of the biggest pharmaceuticals in the world, and it's trading at the moment at their 52-week lows. This is a very big company, very stable business, high free cash flows, and trading at the forward P really low. Is this a value stock, a value investment? Let's find out. So, Bristol-Myers Squibb, a market cap of $102 billion, trading at a forward P of 7. Their revenue growth has been compounding at a rate of around 17%, but this is a very stable business. The revenue has been growing by acquisitions. They had a big acquisition in 2020 where the revenues were around 26 billion, and after 2020 it's above 40 billion dollars. But this is a very stable business. It's not a high growing company, but is a slow grower. Their margins are really great. Their gross margins are around 56%, while their net margins are around 70%. But their free cash flow margins have been above 25%, 32%, 28% free cash flow margins. When you see a company with higher free cash flow margin than net income margin, that is a really stable company, a really good company, and I really love that. Their balance sheet is not the best, but this is a very stable. They have almost $8 billion in cash. Their long-term debt is $32 billion. This is a lot. Basically, their net debt is around $24.5 billion. But since they have high free cash flows, they have been having free cash flows above $10 billion a year for the last 4 years. I would say they could pay their long-term debt with 3 years of free cash flow, even less, 2 years maybe. So I would say this is a pretty stable company. So this debt it's not a danger for me, at least. The return on equity has been 26.5%, and their return on invested capital in the last year was around 12%, and their average for the last 5 years has been around that as well. So a really stable company, a return on equity. The return on investment has been good, actually, above the mean. So they are paying a dividend of $2.46. It is a yield around 4.5-5% at the price right now. Their payout is not under 50% as we like, but it's around 60%, which is not bad, especially for a company very stable like Bristol-Myers. So this is not a technological company. This is a very mature company that is already profitable. They are making a lot of money each and every year. So I really like that. So, but looking to our checklist, it's our check mark. They have been growing. Their margins are really great, really good margins. Their debt, they have some debt, but I do really believe that is normal in pharmaceuticals because they have high capex. They need a lot of investment in facilities, R&D, so that's normal. But their debt is actually manageable. They could pay all their long-term debt in like 2 years of free cash flow. So I would say that's a pretty good balance sheet. Returns on equity really great. Return on invested capital really good. They are one of the biggest pharmaceuticals. They have a lot of drugs out there, so it's not the widest moat in the pharmaceutical, but I would say they have a pretty narrow moat. So they have some competitive advantage since they have really great margins and they continue to make a lot of profit. So they have been free cash flow positive, and they are returning capital, doing buybacks and dividends to the shareholders a lot, actually. In 2023, they bought back 3.2% of the company. In 2022, they bought back 4.4% of the company. This is really great, while paying a dividend of almost 5% right now. So this is a pretty good company. So for me, I would say they will have some stock-based compensation, but it is meaningless maybe. So it is a United States company. I would say the risk to invest in this company is pretty low. So I would say I would have a discount rate for my base case around 11.3%. They do buybacks. So my assumptions for my base case, it will be I'm expecting them, analysts are expecting this company to grow 2% in 2024 and in 2025 around 1%. So this is basically no growth. So this is not conservative as with inflation, and I do really believe they could grow around 4 to 2% in the next 10 years. So for a company like that, it's not high growing company, so it doesn't deserve a premium on their price to earnings ratio based on growth, but this is a pretty stable, really good margins, high returns on invested capital. So I would say they deserve a 16p, a little bit above the mean or around the mean at least. So, and to my discount, I've already explained. For free cash flow margins, I'm expecting them to have 28%. Bear in mind, 2020 and 2021 they had 32%, 33% free cash flow margin. So I think I'm being conservative on margin, and with that assumptions I came with an intrinsic value for me of around $61. So I'm really interested to buying this company under $60. I do really believe at the moment they are trading around $50. So I do really believe under $50, between $46 and $50, it's a really good price that I'm interested in buying this company. I'm looking into this investment, doing my due diligence, and I'm really interested. And at the moment, I do really believe it's one of the best opportunities out there. That's why I'm doing this video for you. I really like this company. It's a very stable company, a really good company that's not growing, but the valuation makes a lot of sense. Right now, trading under $50, it's a really good price. So full disclosure, I do not own this company, but I might be buying some shares in the near future. So I do really like, really great company, high quality company. I'll check marks on the fundamentals we love, and trading at a fair valuations actually, with some margin of safety. So this is a really great company, and it might be a really value investment. So bear in mind, guys, take a look, do your due diligence, and I hope this video makes a favor for you. So if you like this video, please like and subscribe. See you next time.